What goes up must come down, and yes, that even includes the real estate prices in Canada. So today we will discuss how the Bank of Canada is now warning of a housing price drop. You came here for the truth, so let me unveil that for you. Of course, these statements are not very popular, but it is not my intention to win any popularity contests. I'm simply here to bring out the truth and do the best that I can. Let's look at this right away. There's so much to cover. I'm just going to briefly get into everything and hopefully keep this video very short. This is out of the Calgary Herald. Two housing reports released Thursday indicate year-over-year price gains for the Calgary market, but on a monthly basis, the real estate sector is starting to see declines, indicating a correction is on its way. On a monthly basis, the new home prices were flat from December across Canada. They actually fell by 0.1%. A lot of good facts in here, but I want to move on quickly because people are looking at the real estate prices in Canada and they see them from the early 90s up until today, and they are obviously in an increasing rate. Then you look at what happened during the financial crisis and the subprime crisis from the US and other areas where you had obviously a major drop in the prices that were seen. However, the real estate prices, particularly in Vancouver and Toronto, didn't seem too affected by this. But we could be running into a different issue, particularly in these areas here in Canada. Canadian home prices and the price of oil. There is a very large correspondence in between any nation that is exporting a particular commodity, whether that is natural gas or oil or copper or what have you. The economy can definitely be linked in with that particular economy, and if it suffers, surely the nation will as well. This is the West Texas Intermediate, and then you see the other statistics: Vancouver, Edmonton, Winnipeg, and Toronto, and the difference in between the two. As the oil prices decline, you can see how this affects the area in Calgary and Edmonton. Look at this. Taxes comprise a relatively small share of total revenue. So they can increase the taxation all they want, but you have to remember there are other things going on. And look at this. Alberta government revenues. Look at the resource revenue at the bottom there, the dark blue. 29% of the chart is occupied by resource revenue. So obviously they need to continue to make this revenue or they will certainly fail. Now think about this from certain countries in the Middle East that highly depend on oil, in fact being almost their entire exports, their entire revenue coming from oil. What would happen if the prices continue to decline? Well, obviously you're going to have a major crash, and this has effects not just within that country. You don't be so closed-minded. You need to realize how this connects into the wider global economy. These are some statistics here that we're looking at: the real GDP, we're looking at unemployment rate and housing starts, and this is showing you for 2015 not a very good outlook. Minus 0.3 for Alberta. You're looking at 6.8. The unemployment rate increasing over here from a year ago, and housing starts also declining as well. When you have the boom, perhaps it could have been a situation where it was undeserved. But you see this right now that is declining, and regardless, the economy is hurting as a result. Now, once again, out of the Calgary Herald, you're looking at the MLS sales of single-family homes, and the surrounding area have plunged so far this year. You can read more of the stats on your own. I just want to get to the bottom portion when it says this individual, Don Campbell, a senior analyst, when a city or region's economy is based on one major industry, when that industry slows, the consumer confidence in the whole city begins to fade, thus increasing the overall market fear. The reverse is also true. When that industry is in full throttle, the positive impact is just as strong. Look at what happened with the housing boom in the US. The economies that were surrounding, whether it's lumber or whether it's any of these other things, the lending market, of course, they begin to boom. And then what happens when Fannie Mae and Freddie Mac has to be taken over by the US government? That shows you what exactly and how deep this can go. I want to move on very quickly out of the Globe and Mail. Canada's fragile economic recovery has become so thorough and intertwined with oil. This is potentially very bad indeed. What we're talking about here is the correction, let's say, in oil, or I should say the crash. The energy sector makes up roughly 10% of Canadian gross domestic product. That's more than retail, construction, agriculture, and the public sector's contribution to the economy. Energy accounts for roughly 1/4 of Canada's exports. So what do you think is going to happen to Canada should the prices of oil continue to be subdued? Well, obviously it's going to hurt, and the areas that are exporting the most oil are going to be hurt the most. These are the factors that you need to really look deeper into, not just look at it on the national level or a global level. You need to look at cities and provinces and states and the general areas which surround where you plan on buying a home, for example, or where you plan on investing. Lots of good information in this article. But I need to move on to this out of the Bank of Canada. They warned about a correction in 3 of the country's largest housing markets as home values continue to soar in Toronto and Vancouver, even as they fall across Alberta. So whenever you see housing prices becoming astronomical in Canada, the 2 particular areas you need to research are Toronto and Vancouver. They're not really, I would say, overpriced. They are in fact ridiculous. When you get a 100-year-old home and it's not even in the downtown area, in a reasonably good area, that costs you $1 million, and that isn't a large home at all. We're talking about small, narrow houses. That something has gone completely wrong. They called for a soft landing. Don't worry, anybody. Don't panic. This is not a crash. This is not a collapse. It's a soft landing just because the Bank of Canada said so. And of course, they have the control over the interest rates. And I'll try to get to the interest rates in a little while here. I just want to cover the news first. The adverse impact on the price of oil in Alberta continued to robust growth in Toronto and Vancouver suggests a risk of correction in these markets. We're going to see that. We will definitely, absolutely see a, quote, correction in these markets, and that is for many different reasons, not just because of the price of oil, but that is definitely a factor. More good information here. Again, this is actually lots of information here, but I need to move on. In my book, I talked about this. The Bank of Canada's figures show that this is also consistent in the Canadian real estate market. I'm talking about the figures for the mortgage rent ratio, and it is screaming overvalued. And in fact, this is from 3 years ago, perhaps even 4 years ago, where I'm getting these stats. The ratio hit 3.6 times in Toronto in 1989. It was followed by a 29% decline in housing prices. In late 2010, the ratio turned to 1.85 times and has since gone higher. This is one indicator to observe in order to determine where the market is at in terms of value. So, we hit 3.6 times in 1989. It then approached in 2010, which has gone even worse, 1.85. It doesn't have to hit 3.6 again to get a crash. It just needs to become overvalued. And right now, we are in fact overvalued, not just in the mortgage rent ratio, but in other ones as well. Historically, 1.85 is excessively high. 3.6 is absurd. So we will see this definite crash, not just for this reason. But remember that when I give you these indicators, you need to remember them and then search them. And perhaps you're in a different country, a different city or state or province or wherever you are. Use these type of indicators to determine this for yourself. There are many other indicators that I discuss in this chapter in my book, but I need to move on. Look at this out of the Edmonton Sun. After a likely flurry of layoffs in the first half of the year, we would expect businesses to start hiring again later this year. Such factors would support further growth in consumer spending in the province, albeit at a much more subdued pace than in the past few years. Yes, don't worry, don't panic, continue to invest, continue to pour your money in, because everything will be just fine. The Bank of Canada will be there in order to support this. They will bring the interest rates down at all costs. I want to leave off with this report, which tells a little bit of the truth, and that is Canadian consumers are highly leveraged and thus cannot continue supporting the growth of the economy like they have done over the past decade unless jobs are added at the same pace they are in the US, which we know, of course, is fake. The housing sector is also fully valued. I just want to stop there for a moment and talk about the Canadian consumers. Right now, at this moment, Canada's consumers are at the most indebted they have ever been, historically, give or take. They can't continue to support this when they're pushed into such a high rate of debt. So before moving on, I just need to remember one point while I have it in my head here, and that is that interest rates, let's talk about mortgage rates for example, are being pushed further down. They are basically, the Bank of Canada brought the interest rates down, and that allowed the commercial banks to then be able to loan out money for mortgages at extremely low rates. You're talking about less than 3%, I believe somewhere in the 2.6, 2.7 range percent. You can actually take out a mortgage from these big banks, and that is going to show you how desperate they are to keep this going. They continue to bring those down, and of course it's going to push the rates the prices up, or at least keep it at a level they're trying to keep in the positive territory. The housing sector is also fully valued, as I said. In this context, short-term interest rates already at 1%. Hikes appear to be off the table until 2016. Not only a segment of highly indebted and vulnerable Canadian households would have a hard time adjusting, but higher rates could also cause trouble in the housing market and dampen already flat capital investment expenses. This is exactly what I said. They're not going to be able to invest if the interest rates rise, and they're put into this conundrum where they cannot increase the interest rates, and they're off the table, they say, until 2016. Of course, that's going to be 2017, 2018, but all this does is distort the market. The people are more poor. They want to buy a house because they feel like they can, because the rent prices are also very high. And this is going to show you where people are taking out mortgages. They're extending themselves as far as they can, but eventually it has to pop. This is something that you cannot deny. If you found this video informative, please give me a thumbs up. This will be added to the global economic collapse section that I have on my main YouTube page. I definitely recommend checking that out for yourself. I have many videos on Canada. I'm always getting emails from fellow Canadians that are wondering what's going to happen about the Canadian economy. Do some more videos about Canada. And of course, I'm always thinking about you guys, and also all around the world too. This is not just a channel about the US. I'd like to do videos about the global economy as well. So if you are from a particular country and want to see some videos, always welcome to hear from you, and I will try to bring out that type of information. So if you want to get to this, you just go to the main channel page and scroll down a bit, and then you will see the global economic collapse. Last but not least, don't forget to become an insider. It's where I give my best intel for free, and that is available at themoneygps.com. All you have to do is scroll down to the bottom, fill in your email address, and you get occasional emails from me with good, short, concise info.